This is Randy Finney with Right Side of the Chart, and this is a late session update for Monday, February 3rd, 2020. We're going to just focus on three things, and we are going to keep this video brief. Start out with probably what I think is the single most important thing for the broad market. We're looking at QQQ here. This is back here is the start of 2019, so you can see the last year or so of trading. We're going to zoom in tight, a little tighter. And again, here's that trend line that I've been focused on lately. It comes off the October 3rd lows right there, tag there, and we hit it again recently. So what's going on today? As I mentioned, we did have a nice bearish engulfing candle on Friday, but we had a bearish engulfing here. This one's a little more significant because that came at the top, followed with confirmation to the downside. I prefer, obviously, you want to see at least one red candle after a bearish engulfing. Better if you get two, and you didn't get that. But what's going on here, let me say it very simple, is this. We are pinched between support being that trend line. Again, look, another tag, perfect tag there, saved the day, parked it right back above it. Again, right there, closed on it, hit it again today at the lows, and we bounced up. And there's that 220 to 87-ish resistance level against the bottom of the gap right there, or I should say, I'm sorry, the top of the gap. You have the candle back there from that was Friday, January 24th. Remember, we broke this shorter term trend line here. That was also, we were watching that on the 60-minute charts as well of QQQ and NQ. So there was our sell signal breakdown, big gap. The gap was backfilled here, backfilled again, backfilled. That's what we're doing. We're bouncing between support and resistance. Here, I'll get rid of some of those lines and you can see it. So let's not spend any more time on it. I don't care how much we're up today. Yes, the Qs are up strong, but anything in here is just noise to me. Doesn't matter if we're up 1.5 or 3% when you're locked between bouncing between support, that same trend line, it goes to the left there, and resistance. So that's it. Obviously a solid break, impulsive, a solid close above. It doesn't have to be impulsive right away. The more impulsive, the better. And the higher we close above there, the better. That's bullish. It opens the door because at that point, new highs aren't far away. You've also had resistance. The more it knocks against resistance, usually the more powerful the breakout is. So that's the bullish scenario. Bulls want to see that. Bears want to see this. I'm still leaning this way, but as I told you last week, no need to go home aggressively or be aggressively short or aggressively long at this time. Even if you're right on the direction it goes from a purely objective, a risk management perspective, this can go either way, and it can go fast once these levels break. It doesn't have to, but it could, and I suspect it probably will. So again, you see a downside break, that would be a bearish resolution. Solid break, especially a solid close down below that uptrend line. And likewise, a big green candle up and above to close above the 222.90ish. We'll call it 223 or so. There was a little pop above it there, and sometimes you get an intraday pop. So that's QQQ. Not much more to say about it there. 60-minute chart. There's that trend line right there as well. We're above trend, and there's, you can kind of zoom in. This chart's a little messy, but you can see it here. Messy by, a lot of support and resistance levels. But there, remember, that was my max bounce target from back here last week, and it was the top of the gap. We hit it a couple times. You get some. That was a opening candle right there, opening sharp move with order imbalances, but the market immediately reversed, and we're stalling there again. There is something to note here. It's a potential bull flag, so if it's going to break to the upside, as long as it doesn't prove to be a whipsaw signal, that would be a flagpole. This is called a bearish pennant when it takes the form of a pennant instead of a flag. And so a breakout would project, at least have a measured target up to about that previous high right there. So those are things to watch out for. Again, if you break out and then it reverses, the breakout fails, watch for a downside break of the trend line. Okay, and we'll quickly go through the FAANG stocks because again, this is what the market's all about. So Apple, remember they reported January 28th after the bell, so that's your first, that first candle afterwards, that doji, which so far you had a doji there, which is a potential topping candle if it's confirmed with follow-up red candles, which it was. However, you have a pretty decent support here around 305.72. Apple is bucking the trend today, down about 0.8%. Something worth noting, but I often say this. one day does not make a trend. In other words, all the other FAANGs are up green, some of them pretty strong. Apple's at support, and it works. It's just simple, at least to me. 305, 72 call it 305. Today's lows breaks. That opens the door for a move down. I'm still looking for more downside in Apple. That's my preferred scenario. The chart looks, like that will happen to me. But until and unless QQQ breaks down, any short trade in Apple has a much higher rate of failing, because again, support is just below with that trend line on QQQ. Microsoft, all these FAANGs reported recently, holding up here. You got a little cluster of candles. I talk about this when you see a gap on one side, whether it's a single candle or a cluster, you have the potential for an island cluster top, especially after a long uptrend. But what you need for that, the sell signal comes on a gap down that leaves this cluster of candles. Now that could extend if we have another day trading up there, another day, and then you gap down. So just again, a potential short setup or bearish setup. But right now the stock is trading right off all-time highs, and so you can't knock Microsoft yet. Apple, like I said, seen a little bit more bearish developments recently, but not enough, especially with QQQ not giving us that next sell signal I'm looking for. Just not enough really to say with conviction, especially with the trend being so strong recently. Same story here. It's Alphabet, gap down here after earnings, backfilled the gap. So the gap is right here, the horizontal line. I'm talking about the gap below. We had a breakdown right there, sell signal, gap down, and we backfilled the gap. So the theme here is the market really, again, we're pinched between support and resistance. Could be wrong on this, but I think the next 1 or 2% to the upside or downside will determine which way the next 5 to 10% in this market goes. Again, maybe an oversimplification, but if it happens, whether we get that upside or downside break of QQQ, again, you have to take it on face value. And if we get the upside break, point is, I would not be adding to shorts. I'd be more concerned about where to cover. If you're a bull, certainly you could certainly take or add to your longs, and with a stop somewhat below, just in case this market wants to do a little head fake, shake everybody out, and then turn around and reverse and break down. And again, it's all about quantifying your losses compared to your gain potential. So break out. Let's say you did break out and we went up about 1-2%, took out the highs. The highs are we go up just over 2% or so, even 1.5%, just over 1% takes us to new highs. So it's not very far. But then if you turned around from where we're trading right now, I'm trying to zero in here, and you look to where that trend line is below us. I didn't grab it exactly, but you're talking only about 1% to the downside. So that's why, be a little safe, get a margin of error. 2% should do it, maybe 3% would either break us above this trading range and even to new highs, or break us down below that trend line. So that's what I'm looking at. So I'm being patient. I'm just sitting tight, sitting on what I have, not making any changes to my positioning. And I'm talking, when I say that, about my index shorts and Qs. I'm not talking about anything else. I'm going to get to crude oil and natural gas here in a second. Amazon, big gap up after earnings. Remember, that was the only chart that wasn't clearly bearish to me out of the FAANGs, and it was more of an indeterminable chart. And as I said, the trend is up, so that kind of gave a little tilted the odds to any post-earnings move being to the upside. So far it was, but again, you have that potential here. Maybe there's a news catalyst, maybe not, maybe we get something, but here's another stock with the potential for an island cluster top there if we gap down anytime soon and left that island intact. And remember, bigger picture, when we zoom back out, which I just did too, is you gapped right into significant resistance, and Amazon has yet to been able to build on the post-earnings gains and take that out. So you have a potential triple top pattern here if it fails. And divergence as well, not confirmed yet, need to reverse. So these are all the things I'll be watching for. So again, when it comes to the broad market, I think it's a good time to just be patient and let this market see which way things resolve here over the next few days. Alphabet, Here's we already covered the other share class. Facebook has broken down below the minor trend line and hit that 203.61 support. Again, you're roughly similar to Alphabet. Turn all the lines off here. You can see not as clear a triple top as you have on Amazon, but you do have a major reaction there, one there, marginal new high there. But now look, you fell back below, so it's really a failed breakout of that high, of this previous high. That's where we're at now. Again, you're not too far off all-time highs, but this recent price action has been bearish, and that's why I'm still leaning to that more downside scenario. But you just need a few more check marks to really, at least I do, to give me the confidence to get maybe a little more aggressive with the index shorts or individual stocks for that matter. I told you guys if the case for more downside firms up, we'll put out maybe some individual short setups on individual stocks. And then finally, we have Intel. I'll round that out. Sometimes I'll refer to the FAANGs or FAAMG, FAAMG+I, because Intel's the sixth largest component. They reported on Thursday, January 23rd, and you can see a perfect backfill to gap right here. I'll turn off that trend line here. Let's do that for you. Turn off the lines. There's your gap, the bottom of your gap. That'd be the top of that candle right there the day before. And look at that. You can see on the crosshairs a perfect gap backfill. So now, what I could tell the bulls, there's no unfinished business. Most gaps are, not all, but most gaps are often backfilled. So we'll see where this one goes. If the bulls want to take it and run, they at least left that gap, no unfinished business behind, excuse me. And then, what type of gap is it? There's different types. You can look up these terms if you do a Google search. You have breakaway gaps. I'm just scanning this chart. I don't really see breakaway gaps usually after a period of, consolidation. Then you gap up and run. Wouldn't call that really a breakaway gap. This one you could call that a breakaway gap, and then this may be a continuation gap right here, or maybe this was a continuation gap in this uptrend right here, and this is what you call an exhaustion gap that comes near the top. So far you had that big gap up, and that's being faded. It's been backfilled. So really, I guess where I'm going with this, Intel has already backfilled the gap. It should rally from here. So again, like the common theme on a lot of these, the indexes themselves and a lot of these stocks, if we go much lower, that would be a bearish technical event to break that. That was Friday's lows right there. Not the end of the world, but you can see the divergences, overbought conditions, and again, I favor that scenario. And my convictions will get a little stronger if we start to see some of these stocks move down. Again, not much, 2-3% from where we're at now. You'll start to see some support levels that, quote unquote, the buyers should be stepping in at, and these stocks should be reversing off of. And if they don't, then that just kind of indicates that, hey, the supply-demand dynamics have shifted, whereas we had a voracious bid for months now in the market. All dips were being bought up early. Bearish breakdown such as this one here on Intel, you broke down below the wedge, snapped right back up and did that. Of course, that happened right before earnings. So that's that. So that takes care of the market. We could look at SPY, but again, to me, it's mostly about QQQ. A lot of the same components anyways. And there's SPY on a daily chart, 60-minute chart. Remember, we broke down below the rising wedge pattern a while back. This was our breakdown right here. Little kickback rally to backtest, or almost backtest the wedge from below. Been moving lower since. So this is... we have, like I said on the update this morning, kind of a cross current. We do have, what's worth noting is this positive divergence. Pointed out last week, it was potential. It's now confirmed. So there's your 60-minute bullish divergence on SPY right there. But the bigger picture is we are in a near-term downtrend. Sometimes these divergences don't play out. And when they do, it should play out for more. Just the scope of this divergence should play out for new highs. Should, quote unquote. I'm not saying it will. I'm not saying I have strong convictions that it will or won't. But what I can tell you with certainty is that SPY right now remains in a near-term downtrend. What I'm drawing there is a series of lower highs and lower lows. That's what defines a downtrend. That's a simple definition of a downtrend. So we'll see if we take another leg down. Maybe the divergences get extended, or we keep going lower, they get burned through. Remember, QQQ unlike SPY, does not have the positive divergence. We have higher highs on these indicators down here. I'm sorry, higher lows, but yet prices on QQQ never made a lower low. So, all right, let's move on to crude oil, natural gas. I won't spend a lot of time there because I did a extensive post on both this morning. But here's our downtrend line. We haven't broken it. I did, as I often do, I followed up with some comments below the USO, DW or UWT or CL trade idea. I threw out those different options. UWT, for those, I know a lot of you guys out there like the leverage ETFs. That's a 3-time leverage ETF right there, and the chart's going to show a little bit different because of the decay over time. So if you want a pure play, if you're trading UWT, if you're going out to a daily chart, you want to use USO. It's much more representative or more accurately tracking crude futures. That's what it's going after here. And if I take all the lines away, again, I put up a chart this morning. It's pretty simple. This is a very good support level. It starts right here. A lot of reactions come across, and you can see this. So the reason that I took this trade, and I mentioned on the front page, personally I took a starter position, but it doesn't matter what I do, whether I take something or don't take something. What I had said in the comment section there is that the basis for this trade, number one, it's an aggressive trade. Why is it aggressive? Because it's a complete 110% counter trend trade. There are absolutely zero sell signals, nothing remotely close to a sell signal. It is what I call a catch a falling knife trade. The stock could not be in any more of a downtrend. So that's that. But sometimes I'll step in. I like those type of trades. I like the risk reward. So what I'm looking at here is very, very good support. I mean, look at this. This is going back years, and the crude futures has a similar support. So I'm looking at a security, a commodity that's not going away. This is a commodity. There's no Chapter 11 bankruptcy for crude oil. There's no accounting fraud with the CEO. That doesn't exist. This is a commodity, so there's always an intangible value. And what happens? Crude just tends to get, the trades are one-sided. Everybody piles on long. You get too many bulls. Then you have these sharp corrections. Everybody's bearish. Too many bears, they get squeezed out. So the trends are pretty big in crude. And again, you can just go back in time and take a look. Let me put the lines back on and see every time that crude was this oversold. So not only is it at support, but look where it's at. It's about the 20 level on the RSI. It's only been there in the last several years a few times. And right here I mentioned that was the first time it hit it there. You might say, oh, that was too early. You got in, you got killed. No, it rallied 10%. So right now we have near-term bounce targets on USO. It could do the same thing. It could take another leg down. I suspect it will rally soon. And here's the thing. If I'm wrong, your stop's a little below. What I did on this one, you might be wondering if you're new to the site, once in a while I'll do a stop on a daily close instead of any cross. Why? I'll show you why. Because on a security like this, it's very volatile, prone to these sharp corrections, sharp rallies. Usually you get what's called a selling climax. That's the point where the longs that are in the commodity, whether it's a stock or a commodity, whatever the security is, they reach that point where they just can't take it anymore and they break. They throw in the towel. They held on. They didn't think crude could drop so much so fast. Like I said this morning, it's down over 20% in just 19 or so trading sessions. Less than 3 weeks. So if you look at the a lot of those previous lows before we rallied, the ones I just showed you there, every time we were this oversold, what you'll notice is you get these long. See these long shadows, the skinny part on the candle? Let me see if you can't make that in the video. I'll zoom in a little bit. Okay, so the skinny part is a candlestick shadow. That shows you the whole candle from top to bottom is the range in prices that day. And what you get here, you'll notice, are these long shadows or tails. You can call them a tail on the downside. In the candles, and what that means is intraday that it was really down big. People just thrown in the towel. Usually, but not always, you'll get some surge in buying, or at least high volume below that, and then only to see in the security to recover. Even if it closed red that day, you saw a big reversal off the lows. That usually marks a bottom. That's where these long, there's certainly some shadows there in between, but you can see that's what these candles at the bottom have in common. So that's what I'm looking for. If it comes today, great. If it comes tomorrow, fine. Sometimes you can see you're just selling off hard, but that's the common trait. Towards the end, you just see this slide of persistent selling, and it's just, like I said, it's people being squeezed out of their long position, margin calls, or they just can't take the pain anymore. Their stops are being hit. Shorts start to get emboldened and take higher positions than they probably should be, where they should be, locking in profits. And maybe they are. Prudent short. If I was short crude right now, I'd have a tight trailing stop. I might let it go. I'd probably be covering here, but in some cases, if it's in a sharp downtrend, I said I might be covering because of such good support there. But sometimes I'll let it run and just keep tight stops. So what'll happen if you reverse? All of a sudden, you start reversing, the short stops get hit, and that means they're buying. When you're short a stock or security, commodity, whatever, you buy to cover to close your position, and so it creates buy orders, and you get that. So there's what I'm looking for. Again, the details are on the post on the homepage. The targets are based off the I did off the 60-minute chart here, and I also in the comments section mentioned below that if these catch a falling knife aggressive trades they're not, they don't mesh with your trading style, then you can wait for a breakout. There's a nice clean downtrend line there. You can see it there. We have a similar thing on crude oil for you, or crude futures for you CL traders. There it is right there. So there's the divergence. They continue to build. Again, nothing remotely close to a buy signal, but we are at support. So I go back to a yearly chart. And this is crude oil futures. And you can see around the same level here, you have a low there. I could probably I should put a parallel line there. This is where crude seems to bottom. Right here, we'll call that a support zone, down from about 50.40. Again, don't go down to the nearest penny. These are, you have a security in near free fall up to about 51.10. But again, the things that stand out are the number of reactions on that support level. This is where buyers in the past have stepped in and bought crude oil. And again, when it gets this oversold, these are extreme oversold readings. Remember, on an RSI, anything 30 or below, I don't have the line at 30, but it would be up here. You can see between 40 and 20. That would be considered oversold. But with crude, you step in at 30, it doesn't always do the trick. Right here, however, again, that was a 10% rally, and then at that point we put in a slightly higher low, which was positive divergence, and that was a lasting bottom there. And again, or you could have just stepped in here the last couple times that we hit that level, either support, but all the better when you hit support and extreme oversold. So that's it. That's the basis for that trade. And like every trade, it either works out or it doesn't work out, so you have your stop where you want it. But again, that's why, when you have a stop based on a daily close, it does expose you to more loss potential. And let's say crude, we have a major breakdown and crude smashes through here and wants to run at that late 2018 low or even below that. I doubt it with the market holding up right now, but remember, my views on the market, we break support, we can go down more. So in a way, this trade for me is somewhat of a hedge to my index shorts right now, because if the market breaks out to those levels that I just talked about and takes off and breaks the previous highs and keeps running, that's going to show demand confidence in the economy, future economic growth expectations, and I severely doubt crude oil is going to plunge down. Remember, this low right here, this extreme low, happened in the meltdown in December 2018. Remember, the market melted down. Crude and the stock market are usually highly correlated. And this is also something, I'm kind of going off on a little tangent, that is a little bit of a red flag to me here. Crude's been plunging and the stock market is still near all-time highs. There are times where crude and equities disconnect, but for the most part, and especially in recent years, they've traded highly correlated. I believe I showed it on other charts before. All right, let's just jump over to natural gas. Like I said, natural gas, I still like it. It is also a catch a falling knife trade. Make no mistake about it. We're in a downtrend, but we did. The difference here, we had a buy signal recently. There was a bullish falling wedge there. We broke out. Not very impulsive, but we broke out. This happened late Friday or Sunday night. We opened up this morning. We're up here, had a little price channel here. And as I often talk about, sometimes a security breaks out and that's it. It never looks back. And that's why I'll often take a breakout, especially in a starter position. Sometimes you do this, and sometimes you break out, and then a security wants to come in and back test the breakout level, which was the downtrend line or the bullish falling wedge, and then reverse. So it's objective. You have double support here. You have both the back test of the trend line that I just showed you, and you have the previous reaction low right there. So, although I'm not crazy, I never like to see a breakout, initial breakout fail. I don't like the fact it fell back below that 185 level, but it is still back testing as of now, and still objective, I can tell you that. If you didn't buy it here earlier, then it's a better price here, and you can have even a little more aggressive stop than you would have up there. So that's it. If it drops much lower, it's going to take out that previous low. It's going to take out that downtrend line as well. But as of now, just keep in mind, I'm okay with a slightly lower low for the time being. You got to give natural gas room. It's volatile, it moves a lot. The charts would still be constructive. You'd still have, you can see what I'm doing here. I'm extending the divergence lines, but the divergences are strong. When we get a reversal, it's probably going to be a big pop. And whether it comes like this, whether there's a flush out move, a big washout drop like this, and then we reverse, sometimes I'm a little early on these trades. I have a pretty high degree of confidence we'll get up here. I don't want to tell you that, and hold on, because anything is possible. This thing could keep going. So point for me is I'm using, I have a starter position. I'm not going to add until this one shows me a little more, a little more evidence on the bullish side. What would that be? Well, first of all, I want to see it reverse off the trend line, then take out that previous reaction high. If it does that, I would put very good odds that it's going to run up there pretty quickly to that 195.4 level. If it, again, reverse soon, have a successful back test, and then take out that previous reaction high. 185.3 is not as important to me anymore because we already went through and then sliced through it. Now we have a reaction high here after the breakout. That's the level. So if you're pretty darn conservative, you don't want to step in on the back test because it's still a falling knife catch. Catch a falling knife trade, maybe you wait for a break of that recent high. And of course, UGAS, I know a lot of you don't have access to futures. NG is the natural gas futures contract, but you can also do QG, which is a smaller version. It trades in the same exact price levels as that NG chart I just talked about. It just uses a smaller leverage factor. And then UGAS, UGAZ. This is the bullish long one. As I said in pre-market today, all the official trades on the site have always been never futures because a lot of retail traders don't have access to futures, don't have the experience or the capital requirements, and I get that. So there's always an ETF or an ETN proxy to trade. Even I'll share the charts of the futures because I like to chart them. Number one, that's what these guys are trying to track, and number two, there are some traders that like that. So as I said, in pre-market, we were a little bit above there, not very impulsively, but we never triggered that entry because the official trades, a lot of traders also don't trade in the pre-market. They don't know how. You don't have liquidity, the same liquidity in pre-market. If you wanted to take it, it still looks good to me, but we need to break that level. That actual resistance is you can see my lines at 45.70. So I gave it a few pennies just as a margin of error, a little safety buffer there. And so this is what we call still an untriggered trade setup. It's a trade setup, not an active or actionable trade. Needs to take out that 45.73 level, and that's it. It's pretty much testing those previous lows right now there. So these are the stops. In other words, T1 stop, if you're only targeting that first target, you want a more aggressive stop. If you're targeting up here, if it went up there all the way, that's about a 55% gain. You can give yourself a larger stop down to about 9%. That's tremendous. That's better than a 5-to-1 RR, risk reward ratio. So very favorable. But you might say, well, Randy, that's crazy. That's a big stop. 9% loss. Again, the beta adjusted position size. The reason this thing's supposed to go up, or would go up, I should say, not supposed to, would go up about 55% because it has 300% leverage. So keep that in mind. And by doing that, if you take this, trade this one, you need to take a smaller position size, ideally at least 1/3 of what you might normally take, and I even say less, because natural gas without leverage is one of the most volatile commodities out there. You factor in 300% leverage, you need to know what you're doing. Don't put all your money, don't put a fifth of your, half of your account, even 20% of your account into something like this. You don't need to put a lot to make a lot if you get the call right. And if you think it might chop around, you don't have to use the leverage one. There is UNG and some others that don't use leverage. That's another option for you there. You can see similar type chart pattern. You can draw the wedge like this, and comparable targets. Just use the NG chart to align, or you could even try to use the UGAS, but I'd prefer to use that NG natural gas target chart for the targets there. And there's a big thin zone there. You can see that. So that's why I think if UNG, for example, breaks out, and this one, well, the way I drew it, let me get it more accurate. It was like that. So it was a breakout, and it's back testing. But if it can take out that first target there around 15, then there's a big old thin zone right here. I don't know if you can make it out in the video, the volume price histogram. I'll show it to you. I'll make it a little brighter if not. That's these bars. It shows you where a lot of the trades occurred up here. We had not a gap, but a thin zone. There were actually two gaps in there, but it fell quickly. And so this tells us that very few trades occurred, but a lot have occurred down here. And a thin zone works very similar to a gap. Once it's entered from above or below, it's usually backfilled. So this one, again, I expect it to play out like this. Run up there, that 15-ish level, have a reaction, go up, and could, it might not be right away, so don't hold the arrows. It's not exact path it's going to take. It just says an arrow break there means probably a reaction at 1509. If it busts right through there, then that's a buy signal, and it should go up to 1683. Otherwise, if it consolidates there and you missed the initial run, or you took it and you took profits, then you have another buy signal, when 1510 or so is taken out, and that's good for a run up there at about 1683. 1638, and that would be, remember, no leverage in this one. That's about a 15% run. All right, we'll wrap it up here, and if anything big happens today, I'll do an end-of-day update, but I kind of showed you the levels to watch today. So if we close right in there on QQQ below resistance and above support on that daily chart, there really won't be much to update. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.